Alright, so this is seller process for managerial accounting for chapter 23. So seller process is about whether you want to sell a product or continue processing it and make it into a better product. So this problem that we're going to do talks about selling a partially completed product or processing it further and selling it at a better quality product. So, to sell partially completed products as is, or to process them further for sale, depends significantly on relevant costs. So, this product that we're doing is on page 991 of the book, and the problem is about fast track again. So, we're talking about product Q, and so product Q is 40,000 partially unfinished units. And so we found some sunken costs again. So we've already spent 75 cents per unit to manufacture these 40,000 units at a total cost of $30,000, which is just the units times the price per unit. So $30,000 is our sunk cost, so those are gone. So Fast Track has two choices here. Choice one is that they can sell these 40,000 units that are partially completed as raw materials to any company that will accept them and buy them. And this company, let's call them X Corp, would buy them for $50,000. And choice two would be to process them further and produce products X, Y, and Z. So they would produce 3 entirely new products from these processed parts at an incremental cost for $2 a unit. So it would cost $2 per unit to process them more. So as you can see, choice one, we have our partially completed units, which is 40,000, sunken cost is $30,000, and our sales revenue from selling them to X Corp would be $50,000. So choice two would be to process them. So we still have our units, we still have our sunken costs because those don't go away, but this is what our possibilities look like. So product X would be $4. These are all listed in the book, but I just wrote them down. $4 for product X, 10,000 units would be $40,000. Product Y, $6, 22,000 units, $132,000. Product Z is 8, 6,000 units, $48,000. And there's some spoilage. We would lose 2,000 units, but no lost revenue, I guess. So totals, we could sum this up. So that equals 40,000. We have all our units here. These are the 2,000 that are lost. And we can do the same thing over here. See how much money this is. That's $220,000. So the part that is interesting about this is we can't just accept it as is right here because we haven't taken into account some other things. So over here, as we see in the book, this is our revenue that we have that we just calculated. $220,000. So we have to subtract the revenue that we would have made, which is our opportunity cost over here, which is sold as is, which would be $50,000 to X Corp. So you have to subtract that from our revenue because we're losing that money. And so incremental revenue, which is we had our incremental cost, which we showed, which is right here. So 170 is what we're left with, and then we have to add on other costs, which is our incremental cost to process, which is our 40,000 units times the $2 per unit to process these, which is 80,000. So we have to subtract that from our incremental revenue, which would equal our incremental net income, which is 90,000. As we can see, 90,000 is still a lot more than 50,000. So in this situation, Fast Track should choose to process And something really quick to remember is that we don't have to list this in our costs, I don't think. Because they're already gone, they're not necessary in this equation. But it's good to know about so that we don't add them in later. And that's it.